Okay, the recording is started. Okay, so we're going to go over the charts real quick, and then we're going to talk a little bit about the direction of the rest of this mentorship based on what you already know, and then how we're going to build on it, and I'll give you something to go away with for today. So looking at the daily chart, I do not see your comments or questions, so I want to try to keep my focus on the task at hand today, otherwise I'll get bogged down with distractions. The daily chart here on the dollar, we've cleared out the old highs we noted. We talked about these actually in July. There's a video on the YouTube channel, and if you go and look at that, there's, and if I can remember what the link is, I'll tweet it later on. But we had this level here noted back in July, and we essentially cleared it out in here today rather handsomely. We went one more time above last week's high. 99 big figure, 99.10 looks like it could be the next upside objective. That's about the middle of this up candle, which is a bearish order block. And again, if we continue through that, we're looking for a run above these highs up here. Real nice and neat and tidy. I don't like to see the market leave those types of areas in place. So we could see 99, what is that, 99.85 to $1. So that may be the next swing. Let me zoom out just one more stage so that we can see a little bit better. And shift it over. So we have these highs up in here. Okay. We did close in a little bit more of this void in here. We had a little bit of a fair value gap basis. These bodies of these candles, the wicks, again, we don't care so much about that. So if we look at this, it's done a real nice job of getting up there and closing that in. But I still think we got a little bit more to go. Now, what changes this tone on the dollar for me is if we lose the middle of this down candle in here. Okay. So if we get below that, that level comes in at 97.95. So 97.95 to 97.90, the dollar has to stay above that. Because we've covered so much ground, it's been pretty much one-sided all the way up in here. We're getting real close to the elections in the U.S., and we may see a knee-jerk reaction based on who actually gets the vote, or let me say it this way, whoever gets put in office. And I don't know what the outcome is going to be in terms of the election. No one really knows that, but if everything is as crooked as I believe it is, I believe we're going to put Clinton in office, and then we're in trouble. So how that's going to pan out for the dollar will be interesting. Some of the scenarios that we have to look for, if we come down into this down candle here, ideally, in a perfect world, we want to see $98.15, $98.10, find some support. It could touch 98 big figure. I'd rather it not do it. We've already shown a willingness to leave this consolidation in here. But if we go down through that and trade through the 97.90 level, we will close in this void. Now, even if it comes all the way down here, it does not negate my 102 to 107 long-term objectives on the dollar. It just pushes it back a little bit. Ideally, we want to see this consolidation in here where prices expanded through and away from. We want to see this entire area all this consolidation. We want to see price defend any lower prices. We don't want to see half of this, in other words, be broken or violated. So there should be all new buying in here, should be keeping price higher. So we had this down candle, came down to the middle of it, the bodies of the candles rather, and then expanded through it. So they did capitalize this down candle we were looking for, but it threw me off with the lower close and then I just spent too much time last week with it, and I had personal issues too, so I ain't going to make excuses. I didn't read it as well as I would have liked to have, even though we looked for 98.55 for our upside. If we get down into that consolidation again, I'd rather it not, here's my point, what I'm trying to say is, I'd rather it not return back to equilibrium to this consolidation. And the reason why I say I'd rather not see it do that is because we've already moved away from it and we've been running away for a while. In other words, we've been trading higher. So if we go back down to this consolidation, I'd rather see this as like a midway point. Okay, in other words, it would look like something like this. If you scrunch it up a little bit. We have leg 1 here from this low up to the high. And this retracement in here, if we extend that out that same distance, that's what puts us in the 102s to 103 area. Okay, and I'm assuming with that mindset is that this would be a midway point of the larger price swing that's unfolding. Let me give you a rough idea of what I'm saying here. I'm certain that there's some of you don't know what I just said, so let me just draw that out in graphic terms, that way you know. All right, so I'm going to take this consolidation off. So we have all this price swing here. Right in there. Okay, so we have a price leg from this low up to this high. We've consolidated. And if this is the low that starts the second leg, we would see a movement up to the $1.70 in there. And that's just one stage of what I think could be unfolding. But if this is in fact what I think it is, the midway point of a larger price swing up into that dollar mark, we shouldn't see at all any retracement of any kind back into this consolidation. It should just keep running and moving here, going higher. We can expect, obviously, down days, 1 or 2 at the most. We don't want to see a series of down days. Obviously, down days, 1 or 2 at the most. We don't want to see a series of down days because, again, that makes a run against the underlying momentum on the marketplace. If we see, let me go back, put those back on there. If we go and look at what that suggests in terms of upside objectives, notice that it also takes out the old high back here. See, here's the old high right there, and that would essentially clean that out. So if that's all it is that we end up getting, and I don't see the 102s or 107s on a high end, that would be enough. You know, that's certainly enough to find trades in. So it's a little bit over 140 pips. No, what is that? Almost 200 pips, thereabouts. So we have a little bit of range on upside for the dollar. Again, the catalyst is it has to be seeing continued momentum, and this has to be a consolidation and that's maintained, and I can't go back down into the midpoint of that, because if it does, it's not, in other words, if it's not needed to see price come down to that to keep running, because we've already priced in a great deal of buying down here. This is the midway point. So if we understand what was taught on the high probability setups video that I actually have on my YouTube channel that's for free, I talk about how the second stage of that move, whatever move you're looking at, bullish or bearish, once that move breaks above a point of equilibrium, you see a quicker speed. In other words, the magnitude of how fast the market moves to its objective, it's usually very little, if at all, retracements, and it just completely runs to its objective. And I'll give you an example of what that looks like. We have this low here, right in here. I mean, notice, keep track of what I'm showing you. All right, we have a low here. I already know some of you, why are you picking that one? We have this short-term low here. I'm not using this one because this is the one that's just breaking through this short-term high. Okay, so this short-term low, right before this high here is broken, the objective is this old high back here. That's the range we're trading in relative to this point here. This high would be where the liquidity is resting above it. But notice what happens. We have a price move that rallies up, and then we have a consolidation. Now think, If this is a consolidation prior to a known objective where price should sweep above, right above this old high in here, we can draw that out. When we use equilibrium in terms of prognostication, in other words, where the direction of the market should go and why it shouldn't or should return back to equilibrium, we have a pause here. We have a down move. So we have a down move of our correction day. It's a daily chart. We don't look at that as a potential reversal. We expect this to be a consolidation. Okay, so because we're pausing just short of an objective that the market should reach for, the buy stops above here, this should measure what? In other words, if we're consolidating here, we reference back to the previous short-term low here. So using what I just showed you for mapping out where I think that $1 mark on the dollar index is going to be influential, we use this reference here. This is our consolidation, the high, to that low. Now we can take that same reference point and add it here, and it takes us right to that 98.63 level for here, but it takes us more importantly to the 98.55 level over here, which sweeps it. These old highs we talked about back in July. So when we look at institutional order flow and we're looking at following the market on one side of the marketplace relative to where liquidity should draw price up to, that means the buy stops here, the buy stops over here. If we are seeing movement in that direction and it just hasn't happened yet to get there, my point is, don't want to take that off. Let me take these off and go back down. If we have this consolidation in here that's just below the objective we're reaching for near term, this will be the buy stops first, and then the 98.55 level. Let me adjust that to that because that's what the next level was we were looking for. Okay, if we have this consolidation in here, we can reasonably expect to see what happened. Quickness, speed to run to the next area of liquidity, and that's what you're seeing here. Real fast, sudden movement right above these buy stops. Then we consolidated it around in here. Okay, and what threw me off was this down candle. I really rather would not have seen any movement below the midpoint of that, but because it did and it had ECB on top of it, that's why we have all these wicks in here, and then ultimately our 98.55 level did come to fruition. But I say this to say that when we're looking at a directional premise and trades are moving in a specific direction in the marketplace, in other words, if we're looking for a high, okay, and you know an area at which you want to see price reach to, okay, and let's say this is the origin of the move, where it begins, or the low or short-term and that's your objective. Okay, so you have your known area where support should be seen or where the market starts to take off. Okay, you wait for it to come back to a bullish order block. Okay, and then you can expect the price to start running towards your objective. As the market moves in your favor, in your direction, you anticipate halfway through it some measurable consolidation. Okay, and when you have that consolidation, what it'll do is in that small little section of the approximate middle, it doesn't have to be exactly at the middle, okay, but in close proximity where the middle point would be, if you're expecting liquidity above the marketplace to be ran, and you see a reason to be a buyer down in here, okay, and I'm speaking hypothetically here, it's not like these are actual levels. I'm giving you a graphic depiction of what I'm interpreting in my mind, how I can convey it to you. Halfway in the middle of that underlying move that you expect to see form in price action, always think about midway point. Okay, midway point, there's going to be some measure of consolidation. The point is, when you see that, usually the second part or after that midway consolidation of, we don't know how long the consolidation is going to be either. That's one of the gray areas. You don't know how long that price will stay in that middle point before it expands the second part. The thing is that once we do start moving out of this consolidation, okay, and we have underlying expectations for buy stops above the marketplace to be drawing price higher. If you are not long down here or you are unable to get anything down here, you can use ideas in this area to trade with, like in other words, you could look for turtle soup buy signals. In other words, it would be a run below a short-term low. Why would that be significant? Because the market is predisposed to go higher relative to higher time frame liquidity to buy stops. If we take short-term lows out, we know that they're going to be dropping the market below those short-term lows to gather up sell stops. Why? Because they're going to counterparty their sell stops for their buying. And then they'll be able to capitalize new long positions for that second leg up. Here's the takeaway. That second leg is going to be faster than the first leg is. Okay, and that's what we talked about in that high probability trading video on my YouTube channel. The point is you want to be able to see these things ahead of time. By having that understood, the second leg is always going to be faster. It's going to be more dynamic, and it's going to run to the objectives real quick. And the reason why on the other side of that midway consolidation, and every price swing operates like this. Every single price swing operates like this. And I'll give you several other examples here before we close today. But the main thing is you want to anticipate these consolidations between where you think the market should be rallying from, okay, where the buy signal formed from, okay, and it can happen in hindsight, like we use this old low back here, okay. If you look at the videos I did in September, I actually used the dollar CAD to frame the fact that this is probably a short-term low in the dollar. So I used this low in hindsight to justify why I believe these buy stops here would be targeted and ultimately 98.55 would be hit, okay. 98.55 was called back in July, but nonetheless, the point I'm trying to make is if we know that this is an area where price should move away from and start trading higher, and this is the objective, 98.55, let's just throw a fib up here and I'll give you an approximation on where that midway consolidation should occur. There's equilibrium right here, or midway point, and there's your consolidation right there. Okay, so what it's doing is the algo is going to pause there to allow new opportunity to engineer new buying, and it happens sometimes with the run on stops below the market, or they will create another order block that's bullish and they'll capitalize on that. You can't see that here on the daily chart, but if you go into a lower time frame, you can see how they use this whole consolidation right in there, and we'll do that in a minute, but I want to make a more point here. If we also know that this is the midway point, there are times right before and right after you'll have another small little opportunity. Mainly the one here, okay, between where you think the market's going to go relative on a higher time frame and where the support would be. Again, you don't necessarily need to have that initial low. You don't need that. You just need to understand that that's probably where the market's going to move up from. As you get better at your price action, you'll discern when that short-term low, like it is in here, when that's forming, this beginning or origin of the price swing that you're anticipating seeing, and the objective where price should go. In between those two reference points, there's generally 3 opportunities, okay, in the price leg, the impulse price swing, okay. If you have the initial move that you missed, don't worry about it, because if you get an opportunity to trade at the midway point between where the middle of the overall price swing should happen, okay, in other words, what am I saying here? You got 1, 2, 3, 4 segments of the overall price swing. The highest probability is going to be from the midway point to the original point of origination, the buy itself. You can be a buyer midway between where the beginning of the move starts and the midway point of the overall expected price swing. or you can be a buyer after stops on the lows are taken out here in the midway point, or if we start the run and we don't create a move to 3/4 of it, in other words, the overall price swing up, if we start another leg up in the middle here, we run out, and we don't take any sell stops below the marketplace, then you can expect the market to come back down and to trade into a bullish order block and then finish its run to its objective. But I want you to think about the market like this. There's four quadrants, okay, or quarters of every major price swing. Now you can prove this to yourself without very much time at all, going through every price swing and reducing it down into size, and you'll see that these elements are there. And it's not by chance, it's not because it's random, it's because that's how the algo will put pauses in. Okay, in other words, we understand that the market had liquidity at 98.55 on the dollar. We also talked about the likelihood of this being a buying area where the dollar should rally up, and I used the dollar CAD to frame that idea. Okay, and it justified why I believed that the dollar was going to go up. 98.55 was our ultimate objective, but before we got there, this has got to be considered over here, these 97.55 stops. So if we understand that this is the area where price should rally up from here, where the arrow is indicating, and 98.55 is our ultimate objective, before we even traded to this level right here, before these candles in this whole area here even formed, we knew by having a fib, and again, there's no magic in the Fibonacci, okay, I'm just showing you equilibrium. If we knew that 98.55 was our objective, okay, equilibrium is right in here. So we can reasonably expect to see some measure of consolidation right there. There's no magic in that, okay, but what it does is it shows us a willingness. Say we're long down here. Say we were fortunate enough to get long in here on a dollar, and say it's not even a dollar. Say it's whatever market you're looking at, because it doesn't really matter what asset class. It's always the same way. There's prices delivered the same way regardless of what asset class we're referring to. But if we are looking at an objective that draws price higher, and then again in this instance it's 98.55 on the daily chart, the expectation would be, as price was rallying up in here, we don't get excited about the fact that we had a nice down day in here. We don't look at that and say, okay, well, this down day is going to now cause the top in the dollar or whatever asset class we'd be trading. We look at that as that's expected. It should do that, okay? And some of the questions I get a lot is, okay, how do I know that when I'm in a trade, if the market's going into consolidation or if it's retracing, how do I know that that's not going to be a reversal? How do I know that it's not going to be a turtle soup sell? You know, how do I know that I can trust to stay in the trade and hold on to it? What I'm teaching you here today. Because this is, what you're doing is you're breaking down the price swing that you're expecting to see to unfold in price. And the reason why I don't get excited about trades and being in a trade anymore, because these are the boring things that you expect to see. There's 4 points of reference in every price swing, every single price swing. And it's the point of origin, terminus, where it stops, where your objective is going to be, okay? Midpoint, that's equilibrium. But between those 3 points, okay, you have your first quarter and your second quarter. I'm sorry, your third quarter here. There's a pause in here usually, and there's usually a pause here. There's more times than not a pause. Let me zoom in. There's more of a consolidation in here right before it hits the midway point than it is usually a pause in here before it gets to the terminus of the move, or where you think the objective is going to be. Okay, so that's why I'm trying to teach folks that if you trade on the higher time frame charts relative to a daily or a 4-hour, and you're framing an idea where you think the market should move up from and up to a specific level relative to liquidity, by having these larger time frames, it gives you many opportunities instead of just that one initial move. And once you miss it, you feel like you can't do anything about it. If you're using a higher time frame chart, it gives you multiple levels to get in sync with that underlying price move. You may not get that entire lion's portion of the move, but it will give you an area at which to anticipate the next level of trading to form. In other words, where the next signal should form. Okay, so let me give you an example of what that looks like with the dollar here, framing what we've already described. Take all this stuff off. Okay, and again, we're using this low down here, and I can talk about this because I've talked about it in in foresight, in other words, before it happened. It's already in video format, so no one can feel upset about me talking about it just in the form of hindsight. So this candle here was the candle that actually hit 98.55, but 98.55 was the stops on the dollar based on these equal highs back in February, March of this year. Okay, so again, I'm just throwing that in there for completeness sake so you understand why I'm talking about it. By having the fib on the low we anticipate being the point of origin before the next price leg goes higher, and that's our objective, 98.55. That's where we thought the price was going to go. Now we can identify specific levels. Now we're going to map out this whole thing here. I just gave in a graphic depiction. This 95.90 level represents our 98.55 objective. That's where the terminus of the trade would be, or where we think price should draw up to. This point down here at the low represents, in this description here or crude diagram, 94.80. We're using that idea for this point here. So this up arrow is this in the form of the example, and the 98.55 level is represented by the example here for 95.90. So what I'm going to describe here in this crude depiction over here, I'm actually going to apply it to this so you can see how it works. We're going to add around equilibrium. Okay, price should be, now I don't know how far that candle is going to have a low. We'll know exactly that, but we're just going to give a rough idea where we would reasonably expect to see the consolidation or midway point, and then we can go into smaller time frames and see what that actually looks like as it happens. So I'm going to leave the fib on just as it is here, and I'm going to note the midway point here with a line. And it'll make sense in a minute what I'm doing. Okay, so now I have a reference point where I can draw my fib down to, lay right on top of that. Now the 50% mark here, or equilibrium, gives me this little area right in here. So I can draw another area of anticipated consolidation right in here. We don't know how far away or where the candles occur. And I'm going to do the same thing now, just moving the fib up from that midpoint. That's why I drew that line there, noting the midway point so I can anchor my fib. And now equilibrium right in here, look what it does. It gives us an area to expect that new consolidation. Right in here. Come on. There it is. All right, and now we have terminus up here, origin, the first area of consolidation to expect, or where the next level of buying should occur. Then we have another opportunity, which is midpoint, which is here. Then we have our third quadrant, okay, where price would consolidate before it gets to terminus, which is this over here. Okay, now I'm going to look at the questions for the first time. Does anybody understand? Oh, I'm sorry, let me say it like this. Why, while I have it on the chart like this, do you see why and how I did this? So you understand that everything I'm showing you here in a graphic depiction or example, I'm showing you how I do it and look at it in price. Okay. For future reference, if anyone doesn't see it, that's what I'm looking for. I'm looking for the ones that don't. It's easier to see those. It's a big rush of people saying they do. Okay, you don't. Okay, good. All right, stop. Everybody stop saying stop. The fact that I'm not using a low down here, okay, is because this move hasn't broken these clean highs. You see that? These relatively equal highs. This is the reason why I'm using that low. And I know that that's the next price swing that's going to take place. Because as this low was coming down, the market was right in here. So I'm thinking the market's going to go higher. And go back and watch the videos in September. You'll actually see me describe why I believe that US CAD was helping me arrive at the dollar being 98.55. Okay, so by having this right here, the fact that these equal highs hadn't been breached yet, I knew even if I'm wrong, say I'm wrong and 98.55 wasn't happening and say it didn't happen, the likelihood of the market coming up just to clear these highs here is enough to take a trade. Okay, and that's really the strength of what I'm teaching here today. You don't need to have every part of this move. We expect 98.55. I explained and gave you reasons why I believed 98.55 was likely all through here and back even as early as July. But I specifically pulled out an area in price action real time in the last week of September, right in here. Give me a second, folks. I'm not going to be looking at your questions because they're already starting to distract me. But all the questions you're actually asking me, I'm going to be giving it to you in this teaching before I close it. You're all asking how far the range of the boxes and all that. I'm going to explain all that, but I just want you to understand how I took this example of looking at how price swings occur and how to interpret them in scale. Okay, so what we're doing is we're looking at the grade of every price swing. You have a point of origin, a middle point. You can't know the middle point unless you know where, the terminus, where price should go. So where we think the market's going to begin an up move, where we think the market's going to go ultimately, between those two known areas, they're not set in stone because you could be wrong. Okay, but when we're trading, we don't ever know what's going to happen. But if we have a expectation that we believe that the market is most likely going to trade one side, if we see it, that's what I described it back in September, the last week of September, believing that the dollar was going to go to 98.55. The first area would be it has to run through these highs here. So even if we took a long in this area here and it ran up above these highs, that's enough to make money on because why? We're looking at a daily chart. And if it continues higher and it gets into this area here, once it gets into this area, once it trades to the midway point, okay, we immediately go to the thought process, okay, it's moving in my favor. Don't expect it to go parabolic here. Wait for the algo to go into a consolidation. At least give you a down move. It may be, if it's a daily chart, maybe 1 or 2 days. Okay, it may pause and consolidate. And then expand to the up next level, which would be 3/4 of the move that would be expected right in here. And then what should you happen to see here? This is usually where the market many times will not give you this consolidation. Sometimes it'll just quickly run right through here. So the one that usually doesn't appear, it's not always 1, 2, 3, 4, 5 things in terms of the price swing. Sometimes it'll be the point of origin, the first quarter of the move that you expect to see, a consolidation, another buying opportunity, midway point, consolidation, work around the equilibrium, either run out stops below the lows or don't run a stop out, run it higher, and then retrace aggressively back down to a bullish overbought. That's the two scenarios that take place at equilibrium in a price swing. Then once that takes place, you can either pause here or it can just run right to terminus and it's over. So this second one here, that's why I taught, and I still hold to the mindset that this one here, don't expect that one. And that's why I don't really like to be buying above equilibrium because it sometimes won't happen. You know what I mean? So you have to be really focused on the equilibrium price point and being down here, or ultimately trying to get at your point of reference for the original buy or the origin. So knowing where price should go, that's the most important thing. That's why I tell everyone focusing on entry signals, give me entry signals, teach me how to buy and sell, okay? That's an easy thing to do, but the thing that's in your way of knowing how to do it efficiently and profitably is understanding how price moves in price swings like this, okay? So it's meant for conditions and market environments where the market is going to move in a trending environment. This is not what you see in a range-bound consolidation. Okay, if the market's in a consolidation, a large consolidation, or it's not moving higher or lower, this is not going to be what you see in price action. This is only when the market is predisposed to move on one side or the other. In other words, if we thought the market was going to go higher, or if we think that the market's going to go higher, any market, any asset class, it will move like this. If it's going to go lower, everything we have here, you just reverse it. Terminus would be the point at which it starts from, or where the sell scenario would be. It moves down to an area where we think that the liquidity below the marketplace would draw it. Okay, and by having that, everything repeats itself here, just going in a down move. You got to know where it should reach down to. That's the most important thing. Knowing where the market should try to get to. In other words, where is it going? Not where is it going from the next 5 minutes so I can make 10 bucks. Okay, that's not important. The important factor is where is price most likely going to? Because if we can arrive at that, number one, we already know direction. We already know how to trade. We're going to be looking for buy signals, and then we can focus in on where should those buy signals form. Where in price should they form? And that's what this is teaching you here. Okay, we're grading price swings. That's what this is. The concept is called grading price swings. So now we have our areas of reference. Okay, and I'm going to add one more box just to keep everything germane. Now, everything we show in here when we go into a lower time frame, inside the white areas, that's where we should be reasonably expecting. Now, the question is, and I already anticipated this before, and I said this earlier when I was doing it, how far up and down are the ranges when we do these consolidations? Once you have the higher time frame fib laid over top of the price, you really want to keep that in. Okay, you want to keep that on your chart. So I want you to do it just like I'm going to show you here. That way we know every time you do it, it'll be the same way. So now I can't show you. Where is that? Yeah, I can't do it like that. I have to have multiple Fibonacci's on there. Let me see. How can I do that? See, this is the reason why I like to go with pre-recorded sessions with graphics, because it allows me to do a lot more editing and showing the exact levels. But I'm going to try to do my best here to do it. Okay, so we have that one. All right, what I'm doing is I'm going to actually just draw a horizontal line on every midway point on the fib. And I'll show you what I mean by that so we know what I'm doing before I go down to the lower time frame. I have the fib drawn from this low here up to the midway point. This midway point is half of 98.55 to that low. Okay, so we have this reference point here. I'm going to drop a horizontal line there. And at this halfway point here and the low, that's equilibrium, or 50% of it. So that's what I'm drawing here. I'm drawing a line right there. That's why I have the horizontal line there. And now all I'm going to do is pull my whole fib up and anchor it to the midway point here and draw it up to our objective, 98.55. There's equilibrium right in here. So I'm going to draw another horizontal line right there. Okay. Now I'm going to ask you a question. Some of you may not know the answer to this. It's okay. But if you don't, you'll know it now. When we look at lower time frames and we're looking for confluence, confluence is a measure of multiple factors in an agreement with an underlying premise. Okay, in other words, what we use to frame a decision. Okay, they are multiple confluences, and that's what the teaching in number 6 was actually teaching you. What confluences do I look for? In the free tutorials over the last 6 years plus, when I've been teaching foreign exchange, the idea has always been try to look for, high probability scenarios using specific tools and trying to get you to go into the charts looking for it. And part of the free tutorial teachings was really more of a social experiment for me, because I wanted to see if what I was able to do, could it be replicated in someone else? And I had a pretty good sample size of people, and I still didn't get that. So I was a little bit disappointed in that regard, but it's okay. That's why you're here. You're in the mentorship to actually learn the gaps that were there. But I taught that you have to have multiple confluences to support a high probability trade scenario. And I said this back in 2010 on baby pips. The problem is how many confluences and what confluences do we look for? That I left that up to you in the free teachings, okay? Because I didn't want to steer you into making you a clone of me. I wanted you to be able to go in there and be able to pull this information out of price yourself. So if we know that the price action is most likely going to move up here, why? Because we have equal highs in here. We have buy stops above these highs here, and ultimately have buy stops above 98.55, as we discussed in exhaustion. Now we have this whole idea mapped out in the blue shaded area. By running the fib from the low, where we thought the market should trade from, all the way up to the ultimate objective or terminus, 98.55, we can now map out where we can anticipate, this is the key here, anticipate new areas of consolidation. Now, think about IPTA, okay, the interbank price delivery algorithm. It's not random. It's designed. It's going to do these things all the time, and it's fractal. It will occur on every time frame. It's just better to do it on time frames like the daily or 4-hour, because even if you can't day trade, all the trades that you'd ever want to find are going to be found on that daily and 4-hour chart. They're going to be there. They're easy to see. They take a lot of time to form. If you missed the initial buy down here at the origin, okay, where the price leg starts and all this big movement goes up, begins from, so what? So you missed it. Who cares? Okay, you don't need that. Because if you know where the market's ultimately going, hello, that's the most important thing. Where is it going? Because if you understand where it's going, you're not going to blow your brains out about missing the low-end, low-risk opportunity, okay? Because there's going to be another entry. You just got to know where they're going to form. And that's what I'm teaching here today. Grading price swings, okay, will give you, number one, the patience. This is the reason why I never go crazy about missing a trade. I don't care about missing a trade. Sometimes it bothers me, but I'm not going to go nuts like I used to when I was younger. But I understand what you're feeling as a trader when you miss it, because you don't know how to look at how systematic and routine and reoccurring these things happen. And if you have these higher time frame price swings understood using a daily chart, okay, and using the daily, even the weekly and monthly help, but for more frequent trades, trading on the daily chart, if you focus there, you don't need to have a lot of trades, but it'll give you, like we're showing here, each one of these little boxes in here, there's going to be a trading opportunity in, and another opportunity to get in sync to move up to that 98.55 level. Now, obviously, in the perfect world, we'd all want to be a buyer down here in the origin of where the market should start its move. You don't need that. Don't think that you need that, okay? What you're going to do is you're going to wait for the market to give you another area of buying opportunity inside this consolidation, or where we would expect to see a consolidation. Okay, inside a consolidation, it may just be a minor retracement, and then it expands. So IPTA is going to operate in the capacity of giving you a consolidation or a retracement. So for your notes, get a screen capture of this chart as you see it right here. Okay, and inside each one of these white rectangles or boxes, we're delineating the actual levels of 50% or equilibrium relative to the overall price swing we expect to see. Terminus is up here, 98.55. So if we're down here and we think 98.55 is likely, and before that we got to know the buy stops are most likely going to be hit too. If we think 98.55 is the objective, we can start grading the price swing, and by doing so we can scale out where pre-market, before it ever even gets there, before it ever even trades there, before anybody ever talks about it on Twitter, before you always see it on my videos, before you see anything saying this target was hit, you're going to anticipate consolidations or retracements. Think about IPTA now. Think about what I've taught you about that so far. You have consolidation, then you have expansion. After expansion, what's going to happen? Consolidation or retracement, right? Then we have what? Consolidation. Then what comes after consolidation? Only thing can happen, expansion. Point of the origin right here. Okay, we have consolidation. But then we have expansion. consolidation, then we have expansion, then we have consolidation, then we have expansion, then we have consolidation, then we have expansion. Okay? By having this understood and having the understanding of where markets are most likely going to, again, I can't stress this enough, you have to know where the market's going to first. Without knowing, without knowing where the market's going, it doesn't matter what your buy signals are. It doesn't matter where you're trying to buy at. That's the least of importance. The most important is do you understand where the market should be drawn to? And if you do that work about where it should be drawn to on higher time frame charts, see, the thing is most of us that do have the time to sit in front of the charts, you're doing that on a 5 and 15-minute chart because you want to get in there and trade. You want money. You want to be able to make money right now. If you apply those ideas to a daily chart, it'll give you a plethora of trading areas, okay? Because even though if we were a position trader and you trade down here, holding for this objective over here, taking the buy stops here, and 98.55, ultimately, you can take additional signals. So say you bought one down here, one lot, and price goes up here and gives you an opportunity inside this area to buy again. You can. And then it gets up in here, then you can buy another one. And then you can buy another one in here, and then ultimately cash out here. So as a position trader, you don't need to be day trading. You don't need to be doing any of that stuff. But here's the more important thing. As a short-term trader, okay, you have how many opportunities here just on a daily chart? You have a buy down here, you have a buy in here, you have a buy in here, you have a buy in here, and you have a buy in here. So even as a short-term trader, you have the same opportunities as the person that's going to be a position trader. As a day trader, now here is where it really gets fun. Think about, as a day trader, if you know that these areas where we're going to go into a lower time frame, I'm going to show you exactly what it looks like in the lower time frame. By doing this, we can focus in on our buy days in this area. We can reasonably expect to see big up days form. Why? Because it's going to expand out of that area. Holy cow. Think about that. Think about what I just talked to you about. This gives you the knowing when the big range comes. See, when I learned from Larry Williams, there's small ranges and there's big ranges. Small ranges and there's big ranges. It gives you, number one, okay, I can see it in the chart, but the question is, this is like on Baby Pips and people, they're still over there reading those threads. They still talk about it. And in fact, I spent a little bit of time on there this weekend and was laughing because they're still talking about stuff and there's nothing new under the sun. They have no idea, okay? So when I taught that premise I got from Larry Williams, that yes, it's true that the market moves from low volatility to big volatility, or small ranges to big ranges, okay, or quiet markets, accelerated markets, then it goes quiet again, then accelerates again. That's not by chance. That's not just happenstance that it happens like that. It's not a big surge of traders buying and selling. It's the fact that the algorithms are permitting price to release then. So if the market was completely random, if the market was not engineered, you wouldn't see this fingerprint in every price swing. It's there. It's every single time. If you look in price, it's there. Now, it's hard to see it on lower time frames because the algorithm isn't so sensitive on 1 and 5 minute charts. The algorithm is really designed on running on large funds and the liquidity that's in that interbank market realm. Again, the 1 minute, 5 minute charts, you're not going to see it so prevailing there, but it is there. You'll see it because its price is fractal. I want to steer your focus away from those lower time frames and keep the premise on monthly, weekly, daily, 4 hour. You can do 1 hour, but I try not to do it so much there. Okay, there's other things we can use in our tools, like the market maker buy profiles and sell profiles. They're more applicable for things that are less than 1 hour. But for here, and if you don't know what that was, I just said, just relax because you're being taught that in extreme measure in this mentorship. But I'm just giving you pieces. If I give you everything, you can't digest it all. And you have 1,000 questions, you'll be stuck. And you won't allow me to get to the next level because I'll be answering questions that are easily understood and answered by being in the mentorship, going through step by step. So having these framed out like we have here, okay, if we go down to a lower time frame, we're going to go down to a 4-hour. Okay, so we have another look inside this area, and now I don't want you focusing so much on these boxes, okay, because the boxes were just to highlight the rough area. The point is I want you to look at the exact line, okay, that line here, this line here, and then terminus being 98.55, and the point of origin of the move down here, okay. I want you to look at how the market gives us opportunities very close proximity to these levels right in here, to these lines. Now, when I taught on baby pips, confluences, okay, for those that were with me since then, back in 2010, and that have all my notes and resources and things that I talked about, this is going to be very easy to remember because it was the only time I ever talked about specific terms of pips. When I talk about sweeps on stops, I teach it in 10 and 20 pips. That's the only time you're going to hear me specifically refer to pips. Apart from that, the other one was I allow up to 15 pips of movement, okay, away from a level I've already identified. So what I mean by that is if I think this level here, where's it at here, 96.79, I am permitting about 15 pips below it and 15 pips above it. Why am I doing that? Because the delivery of price, our data is skewed. When we trade off of a retail trading account, the data that we're actually seeing is not actually in agreement with what the interbank price is. Many times it's really off. And that's part of what makes the trading retail Forex so hard, and it's difficult because the broker has a little bit of leeway, and in the right times a lot of leeway to spread the price a lot farther, and usually when it happens it's going to help them because they have an underlying book that their book is showing more buyers in other words their customer base is more long than they are bearish, and by having that expansion on the spread usually comes out when market releases and data releases, they make a run on their own house customers, okay, and yes, they cannibalize their customers, and you gave them permission when you signed up for it. So don't complain, don't complain about it to me, don't complain to that, because it's all you whether you realize or not, you signed those documents giving them permission to do that. But keeping things going along, I want you to think for a second. Look at the chart here for a second and think about 15 pips away from these levels. We have price here. If I can get it to show up here. Okay, the low comes in at 96.48. 96.48. From this level, we don't see anything here. It expands away from that. 96.40. I'm sorry, 96.79, which we round to 96.80. The low on this candle comes in at 96.71. Price moves out of this little range in here. Now again, we're looking at a 4-hour chart. We're going to go into a smaller time frames as we go. This one in here, we're going to take a look at that one right in here. So this is another opportunity. So we'll look at this because that would create another new potential order block right in here. So we'll have that in mind. In here, we have the market trading. Well, it trades right down into it actually. The low 95.95 and the level is 95.95. But this down candle at the level, it's violated here on this candle here. Again, all we're looking for is a penetration of its high. It does that here. So if it comes back down into that candle, which it does right there, you can be a buyer. Now the low on this candle comes in at 96.04. 96.04. The level is 95.95. Is that 15 pips? Yes. So you can see a buy here, okay, close proximity to where that consolidation or retracement should occur. We'll have to look at this one here on a lower time frame. In here, we have consolidation in here. We have an order block down here. Price trades into that as well. The level is 97.67. The low is 97.49, so it's a little bit beyond 15 pips here. Price makes a bullish order block here, and it's confirmed when this candle trades through it right there. This down candle becomes an order block that's bullish on this candle. So if we trade back down into this candle, we can be a buyer. It does it here, and it does it here, and it does it here. The low on that candle comes in at 97.60. The level is 97.67. Is that 15 pips? Yes, it's less than 15 pips. That's my point. All these signals are forming at predetermined levels before price ever gets there. When I said this back in 2010 on Baby Pips, that I already know what you want to know, and I know where to see it at before it happens in price. I can talk about this in great detail, and if I put this on YouTube as it is, as I'm showing you right now, and someone first signed on to that video for the first time, they're going to say, oh, this is all hindsight crap. This is all hindsight crap. These are all things that you're talking about what happened in the past. But they don't go back to the July video and talk about how 98.55 was called back then. They didn't see in September where we were talking about the 97.65 and 97.55 level and 97.20 level. They don't know about those because they weren't around. But you're in here learning what gives me the ability to do these things that you see in video that's repeating all the time. There is no randomness to price. Zero randomness. And the reason why it's not random is because it's controlled. And it's not controlled in a way where you can't see what they're doing. That's the beauty about this. And if this does anything, if it doesn't do anything but at least relax you about how by me teaching this, is it going to stop working? No, it's not going to stop working. It's not going to stop working because, number one, I could tell you in the USA Today newspaper, I can go on the internet and on the TV and make video free commercials, infomercials, selling nothing, just saying this is what the market does. And largely everyone would laugh me off of the internet. They would laugh me off. Well, they did it on Baby Pips. They laughed it off. Okay. The fact that I would be talking about it and sharing it, nobody would believe it. They won't. Number one, most people are just lazy. They're not going to go in and prove it to themselves, which is what my challenge was on Baby Pips. Go in and see what I'm teaching isn't there. And for the most part, because it wasn't give me a buy say, don't give me a sell say, don't show me how to trade, give me your MyFX book, they weren't interested. And that was part of the social experiment for me, because I know that there's going to be a small little percentage of those individuals. They're going to actually put the work into studying what's necessary to see these things. And because of my obsession, just being in here looking at price for 20 plus years, this is the only reason why I was able to discern this stuff. Because no one sat down with me and said, this is what you do. You do this, you do this, you do this. These are just things that I saw repeating. And I said, you know what? If everything is rigged, which is what I believe, and I believed it back then, there was some kind of guy on the other side that was hurting me. And I just thought it was my broker. But it's not him. It's not Oanda. It's not FXCM. It's not them. It's the central bank. Because they reprice and they take price to a specific level, price is going to be controlled by them remotely. They know exactly what they're going to do with price before it ever happens. And I don't care what anybody wants to say against it. I'm telling you, you're never convincing me of it because I got it down to a systematic science. There's no denying it. I prove it. I can show it to you in a chart before it happens. I can show it to you millions of examples in the past. I can do that because I know what I'm talking about by seeing it happen for a long period of time. And I'm convincing, hopefully, all of you that are in